Hi, welcome to another video in the AS A-Level Financial Accounting series. This video is about ratio analysis. One of the important parts of the accounting process is the interpretation and analysis of the accounting data. Once the financial statements are ready, the next step is to analyze the data, interpret the data, and then take the necessary decisions. So to analyze the data, one of the tools that we use is called the accounting ratios, or you can call it ratio analysis. So there will be two parts for ratio analysis. There'll be two videos. Part one that we're doing now, that will be based on the AS level ratios, so the ratios that are covered in the AS level. And then there'll be a second video that will cover the A level ratios. This is if you are following the Cambridge board. If you're following any other board, then the ratios might be in one of these videos. So watch both the videos and then see which ratios are relevant for you. So let's begin this video. So what are accounting ratios? Accounting ratios are, or accounting ratio is a tool that uses two or more elements from the financial statements. Financial statements could be income statement, balance sheet, and then you'll study that there's something called cash flow statement or statement of changes to equity. Two or more elements or line items you take from these financial statements and then use them to calculate a certain number, a certain ratio. That ratio will actually tell you about the financial condition of the business. The financial condition of the business could be in terms of profitability, how profitable the business is, or liquidity, whether there is sufficient liquidity in the business or no. And there are many other areas of the financial condition that can be analyzed using accounting ratios. So in our syllabus, we have three broad areas to be covered when it comes to accounting ratios. We'll be doing profitability ratios, liquidity ratios, and efficiency ratios. Broadly speaking, profitability ratios will tell you how profitable the business is, or whether the business is profitable or less profitable compared to its peers, or it is more profitable or less profitable compared to the previous years. All of that these ratios will tell you. Then the second category is called the liquidity ratios. Now these ratios will tell you about the liquidity position of the business. Liquidity means the extent to which the business is holding liquid assets. Liquid assets means the assets that are almost cash or almost easily convertible to cash. So liquidity ratios will tell you about the liquidity position of the business. And finally, we have the efficiency ratios that talk about the efficiency in business operations, how efficiently the business is conducting its day-to-day operations. Now, some of these ratios are already covered in IGCSE and I've already made a video on this. So out of these ratios under profitability, the gross margin, the gross markup, net profit margin, and return on capital employed, these four. And then in liquidity ratios, the current ratio and the liquid ratio, both these ratios. And in the efficiency ratio, the trade receivables turnover, the trade payables turnover, and the rate of inventory turnover. All these ratios have already been covered in the IGCSE. I'll put up a link of that video in the description box. You can watch that video and you can learn about these ratios. In this video, I'm not going to repeat about these ratios again. I might just take up these ratios briefly, just tell you what the formula is, and then I'll go ahead and do the ratios which I have not covered in IGCSE. So in this video, we'll mainly focus on expense to revenue, operating expense to revenue ratio under profitability. Liquidity, we're not doing either of these. And then in efficiency, I'm going to focus on non-current asset turnover and inventory turnover. So under profitability ratios that are covered in IGCSE, the first one is gross profit margin. The formula is gross profit upon revenues into 100. It is expressed in percentage terms. It tells you for every $100 revenue, how much gross profit the business is earning. Higher the number, better it is. Or in other words, you can prefer a business that has higher gross profit margin because then its overall profitability also will be higher. Similar to this, we also have one more ratio, gross profit markup. The difference is in the denominator, instead of revenues or sales, we have cost of sales. So basically this ratio is expressing gross profit as a percentage of the cost of sales. So for every $100 cost incurred in the business, how much gross profit is being earned. Then we have the net profit margin that tells you as a percentage of the revenues generated, how much net profit the business is making. So that is also in percentage terms. So for every $100 revenue, how much net profit the business is making. Obviously, higher the number, better it is. And then we have return on capital employed, which is operating profit divided by capital employed. What do you mean by operating profit? So operating profit means the gross profit. The gross profit means what? Sales minus the cost of sales. So profit purely by selling. So out of the gross profit, if I subtract the operating expenses, we will get the operating profit. And that when we divide by capital employed. So what is capital employed? It is the equity, which is the owner's balance in the business or owner's shareholding in the business, plus the non-current liabilities of the business. When you add them, you get the capital employed. When you divide, you will get the return on capital employed, which is also expressed in percentage terms. What this ratio tells you is that for every $100 of money invested in the business, whether it's by the owner or it's by a lender, so every $100 invested in the business, how much profit can the business generate? So if, let's say, if the ratio comes to 40%, it means for every $100 you put in the business has the capacity to give you back $40 every year. So that is the meaning of return on capital employed. Again, you can watch more about these ratios. You can learn about them in the video that the link of which I'll be giving in the description box. So now let's continue with the other profitability ratios in AS level. The first one is called the expense to revenue ratio. This ratio expresses the total expenses of the firm as a percentage of the revenues generated. In other words, for every $100 revenue, how much expenses the business has incurred. These expenses could be operating or non-operating expenses. Just to tell you, what's the difference between operating and non-operating expenses? Operating expenses are all those expenses that are necessary for business operations. So every business is set up to do a certain activity. In doing that activity, let's say to manufacture products, to trade in some product, to provide some services, in doing that regular activity, whatever expenses are necessary, such expenses are called operating expenses. But if the business is incurring any other expense which is not for business operations, which is not necessary to continue with business operations, but for some other purpose, then these expenses would be non-operating expenses. The best example would be all finance related cost, which means, let's say the business has borrowed a sum of money from bank, and on that they have to pay interest. Now interest is an expense, but interest is not necessary for business operations. It is necessary to finance your business. Hence, all finance cost will be non-operating expenses. And in your operating expenses, you have so many examples. You can pay rent, salary, depreciation on assets, insurance, telephone, electricity. All these are your regular expenses which are necessary for operations. If you don't incur these expenses, your business operations may halt, or it will not be very smooth. So that's what this ratio tells you, the percentage of operating plus non-operating expenses to revenues. And what is the analysis? And let's say when we have this ratio, we compare it with our peers, or we compare it with previous year ratio, then what can we analyze, or how can we analyze about it? A higher expense to revenue ratio is obviously bad for a business, because it indicates that the business has lack of adequate control over business expenses, and it also means that overall the profitability will be low for this business. Then how can we improve this particular ratio? Maybe the business can have better control over its expenses. The unnecessary expenses can be cut off, can be reduced, and the business can also try to increase its overall revenues. So because when it increases its overall revenues, the denominator in this ratio will increase, and overall the ratio will decrease. That will mean the business is performing better. But yes, the revenue should increase without proportionate increase in the expenses. That can happen if the business expenses are mostly fixed cost. Let's say you've taken a premise for rent. The rent is very high. So currently the expense to revenue ratio may look very high, but using this premise, using this building that has been taken on rent, if the business can increase its revenue properly in a good percentage, in good proportion, then the expense to revenue ratio will automatically become better in the coming years, because revenues will increase but expense will not increase to that extent. Then the second one we have is called operating expense to revenue ratio, which is similar to the previous one. The only difference is in the numerator, we're just taking the operating expenses, we are excluding the non-operating expenses. The analysis is same. A higher operating expense to revenue ratio will indicate that there is lack of adequate control over the operating expenses of the business, and overall its profitability will be low of the business. And again, how to improve this ratio? One business can ensure better control over its operating expenses, whatever are unnecessary expenses that can be reduced, and at the same time they can also try to improve their revenues without increasing their operating expenses proportionately. Then going on to the liquidity ratios, the liquidity ratios that were covered in IGCSE are current ratio and the liquid ratio. So the current ratio formula is current assets divided by current liabilities, and it is expressed as number is to 1. So for example, if you get this ratio as 2.5, you will express this ratio as 2.5 is to 1. This ratio tells us about the liquidity of the business, because if current assets are higher than the current liabilities, then it means the liquidity is good. The business can generate sufficient cash from its current assets to pay off the current liabilities. In IGCSE, we used to say that the ideal ratio should be 2:1 for a business. So the current assets should be twice the current liabilities in a business. But yes, this number will vary from industry to industry. For a particular industry, 2:1 can be a good ratio. But for some other industry where the business needs to hold, let's say, a lot of inventory, there the ratio will be a higher number, and that will happen with all the firms in that industry. So just telling you that the ideal ratio should be 2:1. Anything below 2:1 could be said as a risky situation, because then the firm may not be able to generate sufficient cash to pay the current liabilities on time, and there can be defaults. And the second one is the liquid ratio. The change in this ratio compared to the previous one is that in the numerator, we are only taking liquid assets. So what do you mean by liquid assets? Out of all the current assets, if I deduct the inventory, I get liquid assets. So the trade receivables, the cash balances, bank balance, all these are liquid assets. So in the numerator, I'm just taking liquid assets. That when divided by current liabilities, we get the liquid ratio. The expression is still the same. Let's say we get the number as 1.5. So we'll write it as 1.5:1. Ideal ratio for this liquid ratio is 1:1. It means any business should have at least liquid assets equal to its current liabilities. If not more, at least it should not be less, because this ratio tells us whether in the very short term business will be able to pay its current liabilities or no. Why is inventory excluded? Because inventory in all cases may not be able to generate cash for the business within, let's say, 1 year, because we are talking about current liabilities that have to be paid within 1 year. So sometimes inventory does take time to be sold off, and then it takes time to receive cash from them. Hence inventory is excluded to see whether the business will be able to still pay its current liabilities if inventory is not included, because inventory may or may not be sold very soon. Apart from these two, we don't have any other liquidity ratios in AS level, so just these two. Now let's see the efficiency ratios. First, the ones that were covered in IGCSE. Rate of inventory turnover. Cost of sales upon average inventory, it is expressed in times. So what this ratio tells you is that on an average, how many times the business is turning its inventory. Turning means selling. So if it is buying inventory and selling inventory, how many times is it doing that during the entire year or month, whatever? Then it depends for what duration you're calculating. So higher the ratio, better it is, because then it means that the business is buying and selling its inventory faster. It is rotating its inventory faster, and when you rotate your inventory faster, there are less chances of obsolete inventory, and also the storage cost reduces. Then trade receivables turnover, that tells you on an average how much time are the debtors taking to pay the business. If you multiply it by 365, obviously it will be expressed in days. You can also calculate this in weeks, in months, depends. Then you'll have to multiply it by 52 weeks or 12 months, but let's keep it as days. Most of the exam questions are based on the number of days. So this number will have to be compared to the credit period granted to the customers, and then it'll have to be analyzed whether the business is efficient enough in collecting the debts from the customers on time, or it is very lenient. it is not very serious about collecting the debts on time. And similarly, trade payables turnover, that tells you on an average how much time the business is taking to pay its trade payables or creditors. So the ratio for trade receivables turnover was average trade receivables upon net credit sales. Keep in mind only the credit sales you will use in this formula, while the ratio for trade payables turnover was average trade payables upon net credit purchases multiplied by 365. So the number of days that you take to pay the creditors. Going ahead with the efficiency ratios, the other efficiency ratios in the syllabus. First one is non-current asset turnover. That indicates the efficiency with which the non-current assets of the business are being used in the business to generate revenues. You buy non-current assets to obviously maximize your revenues, to ensure that you can sell more products, provide more services, and ultimately increase your revenues. So that's what this ratio tells you, whether the non-current assets that have been bought and are being used in the business, are they being efficiently used to maximize or optimize the revenues or not. So the formula would be revenues upon net book value of the assets. What do you mean by net book value? The cost of the assets minus any accumulated depreciation till date. This ratio is calculated again in times. So this ratio tells you that, let's say if you've invested $100 in the net book value of the assets, or in the non-current assets, and the book value of that assets as of date is $100. So using these $100 worth of assets, how much revenue are you generating? So let's say you're generating $500 worth of revenues, then this ratio becomes 5 times. So it means that you're using your net non-current assets and generating ratios up to 5 times to that of what you've invested in non-current assets. Obviously this ratio you cannot just calculate and look at the ratio and decide whether it's good or bad, or whether the business has performed well or not. You'll have to compare it with other companies, other firms in the same industry to see whether are they doing the same, or are they using the non-current assets better than us, or we are using it better than them. You can also compare this ratio with the ratio of previous years of the same firm to see whether over the years our performance has improved or not. So if the ratio increases, it means the business is using the non-current assets better and the performance has improved. So higher the ratio, better it is. So analysis, it's the same thing. A high asset turnover indicates efficient use of non-current assets, and the assets have been used to maximize the business revenues properly. And let's say the non-current assets to revenue ratio is not as expected, then what can we do to improve the non-current asset to revenue ratios? Sometimes the business may have non-current assets that are being unused, that let's say we've bought it, they're lying idle. What we can do is we can dispose of the unnecessary and unused non-current assets, and those funds can be utilized better in the business, maybe to buy another set of non-current assets that can maximize revenues. So what that can be done. And let's say suddenly for a business the ratio it has reduced in 1 year. Why would that happen? Let's say the business has done major investments in non-current assets in a particular year. So in that year, obviously the ratio will decrease, because when you buy a non-current asset, the benefits may not be visible in that year. Maybe in future coming years, the benefits will be seen. So if the ratio has suddenly decreased in a particular year, you'll have to analyze, why is it decreasing? Is it because revenues have reduced, or is it because the business has made huge investments in non-current assets? If it's the second case, then we will have to wait for coming years to see how the investment in non-current assets has been justified by the business, and whether the revenues are increasing or not in future. Then the next one we have is called the inventory turnover. The previous one that we saw the formula of the rate of inventory turnover, that was rate of inventory turnover. It was covered in IGCSE. This is inventory turnover. Both these ratios are related, but they are different. So what does this tell you? This ratio, inventory turnover, tells you that on an average, how many days of inventory is the business holding on any date during the year. Basically the average inventory period. How do you calculate this? The average inventory divided by cost of sales multiplied by 365. So let's say we get this as 30 days. So what does this mean? This means that on an average, the business is holding 30 days of inventory. So we can go on selling our inventory for 30 days without, falling short of inventory. So after 30 days, we may fall short of inventory. This is an average number. On an average, the business is holding 30 days worth of inventory that can be sold. I told you this is related to the rate of inventory turnover. Why? Because if you remember the formula for rate of inventory turnover, it was cost of sales divided by average inventory, which is just the reciprocal of this formula in times. And this is the other way, in days. The analysis for both these ratios are same. It's just a different way of expressing. In the rate of inventory turnover, analysis was that we need a higher ratio, a higher rate of inventory turnover, and then we can say that, okay, the business is selling its inventory faster and it is good for the business. But in the inventory turnover or the average inventory period, we want our ratio to be lower. Basically, we want the business to hold less inventory on any given date or on an average during the year, so that our storage cost is less, so that our obsolete inventory is less. So analysis would be a high inventory turnover would indicate that a business is holding high levels of inventory on an average, and that can lead to high storage cost and high wastage due to obsolete inventory. So we want a lower inventory turnover. Well, again, this is subjective, because let's say you talk about a business that is not maintaining, huge stocks of inventory. They can sometimes be at a disadvantage also, because if customers are coming to them and they are not getting the items because the business is not maintaining sufficient inventory, these customers can then go on to the competitors and they can buy from the competitors. So that can be a loss to the business also, but then it depends from business to business, because the moment you start increasing your average inventory period, you'll also have to incur high storage cost. So you'll have to decide what is the best inventory period that the business has to decide how much inventory they should be holding, so as to not turn down the customers also, and so as to keep the storage cost or the wastage due to obsolete inventory at the minimum. How can we improve this ratio? When improving, I mean to say, how can we reduce this ratio? Because I want a lower inventory turnover, we can stock more of fast moving items. So in a business, there can be fast moving items and slow moving items. Fast moving items are items that there is high demand for these items and they are sold faster. So the business can try to maintain high levels of such inventory items so that the inventory is not held for a long period before it is sold. And the business can also, reduce its selling prices or offer trade discounts to customers so that its revenues increase, its items are sold faster, and it is not holding a lot of inventory. Its inventory is getting cleared faster. This will reduce the chances of obsolete inventory. So this covers all our ratios in the AS level. Obviously, just looking at this presentation or looking at this video and just looking at the formulas, you'll not be able to remember the formulas. You will have to make sure that you watch this video or read any other chapter on ratios, and then make sure you practice questions. Take up numbers, practice questions, try to read the analysis that is given in the marking scheme and learn how to analyze the ratios, because at this level, AS and A level, analysis is more important than calculation. Obviously, you'll get to calculate, but you'll also have a lot of marks for analyzing the ratios, whether according to you, the ratio that is calculated, it shows a good performance by the business or a bad performance, and how can we improve the ratio. These are some of the ways in which theory questions on this chapter can be tested. So I hope you liked the video. I hope you understood the concept. If yes, please like the video, please share the video with your friends, and the next video on ratio analysis will also be uploaded soon. So make sure you subscribe to the channel, and then whenever that video is uploaded or whenever future videos on accounting are uploaded, you can watch them. Thank you for being there. I'll see you soon in the next video.